Hey, what's going on, everybody? This is Ron Simplified Myers. What I wanted to talk to you about on today's video happens to do with the major problems that surround your cash value inside of your life insurance policy if you have one that has a savings component. The reason I want to share these points with you is because I want you to be able to go in and look at your own policy away from any influence from anyone else, because you and I both know that if you ever went to court, the judge is going to only ask you what's inside the policy. They don't really care. What an agent told you is going to be what's inside the policy, so you need to be able to look at that for yourself. So what you can do is you can look inside the program, and in the first or second year in most programs you have no money inside of the cash. Now, why is that an issue? Well, when you first bought the program, isn't that the reason that you bought that policy, is so that you would have in investment or savings or college fund or retirement or however it is that they sold it to you. So you actually paid more money by buying the one with savings so that you could have a savings component. So the question is, if you paid more specifically so you could have a savings account, why is it that you have no money saved? Now, an agent will tell you, well, that's just the way it is in the first couple of years. We have to get administration, different fees out, but, you'll start making a lot of money down the line. Well, I don't understand putting money in a bank account, and then you tell me, well, don't worry about the first couple of years. I know you're putting a bunch of money in specifically to save, but in the first couple of years, don't worry about it. We're going to keep all that because we got different things we need to do with it. And then when you start making money, it'll start to grow, and you'll have a lot of money. Well, I wanted to start growing the day that I put it in, personally. So that's why I'm considering that to be an issue, that you have no savings. Then when they do start paying you an interest, but before I get off of the subject, because the life insurance industry, because consumers were being educated on that point, what a lot of companies have done now is they put money in the program in the first couple of years. So in the savings part or in the cash accumulation, it'll show that you actually have some cash. So you go, see, Ron, you were wrong. I do have cash. But this is what they did. They put surrender charges inside the program, and basically the surrender charge outweigh how much cash you have in there. So in other words, let's say you had $100 cash inside the policy, but the surrender charge is $200. So that means you would have to pay them $200 in order to get your 100. So bottom line is you have no cash. It's just a sneaky way that the industry has found to address that particular issue, because more and more consumers are looking at the policy and realizing something's not right here. So again, it's another sneaky tactic used by the life insurance industry. Now, when you do actually start really gaining money, you're going to make somewhere between 1% to 3% on your money in most cases. You can do the research, you figure out how much you put in, and look at what it's grown to, and you'll find out that you've usually made 1% to 3%. And if you add in those first couple of years that you didn't get anything, you're in the negative. Probably in 4th, 5th, 6th, 7th year or however long, you're actually in the negative, because the fact is you haven't earned back what you lost in the first couple of years yet. So let's say, for example, they do their illustration where they're talking about you earn 12% because it's tied to an investment. Well, here's the key. It is tied to an investment vehicle, as far as they're showing you how the cash is figured out. But it's still, when the bottom line is, it's still two different vehicles going on. You have life insurance, and then you have a cash component. My question is always, if you're putting me into a fund, a mutual fund or whatever the case may be, whatever it is that you're investing in, they have different names, indexes or whatever games they want to play. Couldn't I actually buy term insurance and invest the savings into that same exact fund without having to go through a life insurance policy and paying you all those fees? Interesting. But an agent will say, no, you want to have it inside the program. Why? Because it makes me more, because it's in your best interest. We both know it's because it makes them more money, and it's because it's also what's best for the company. So then think about that. Once you actually finally get some money into that program, which is such an awesome program according to the agent, when you need it, you can borrow the money. That just amazes me, how you can have a savings vehicle and you have to borrow your own money. But here's the key, and I've had agents tell me this, but Ron, where else can you go borrow money at 6 to 8%? Borrow money at 6 to 8%. I'm with you. But when it's my money, borrowing at 1%, borrowing at any percent, I got a problem with it. It's my money. Give me my money. So that's a concern. Now let's do a brief recap. The first and second year you have no money. Then when you finally start gaining interest, you're going to usually get somewhere between 1 to 3. Even if the illustration shows that you're making 6 to 12. I always tell people, look at the guaranteed inside that policy. And think about this. If you're an insurance company, I have a choice. I can give a person a guaranteed amount, or I can give them what I said could possibly happen, which is the illustration part. And every person I've ever asked that has said, well, if it's up to me as the company, I'm giving you the guaranteed. Now, if you and I have figured that out, what do you think the company going to give you? Just an idea. I'm just throwing it out there. It's up to you. But then when you do actually need the money, you can borrow it. And did you know that they actually have up to 6 months to send you the money if they choose to? Now, ain't that incredible? You trying to buy a home because that's what you told the agent. Hey, in the next 3 to 4 years, I want to buy a home. They said, hey, put money in this great program. You'll have a ton of money at the end of the rainbow. So you put money in there, year 3 come, you get ready to buy your house. You're like, hey, we just need like 2 or 3 grand out the policy. It's all we need. And we getting ready to close in a couple of weeks. So let me go get a couple thousand out of my policy real quick. Nothing to it. I'm not saying you won't get it, because you can in some cases. What I am making you aware is legally they have up to 6 months to send it to you. So you're counting on that money to close your escrow. They may send it to you, they may not. I'm not saying they are or they won't. I'm not, again, saying right or wrong. I'm just letting you know, legally, they have 6 months to send you your money. That's another concern. You know what I'm saying? It's my money. Give me my money. So those are the issues that I have with the cash value program. And not only that, later in life, remember the premium is going to go up, but the agents are going to tell you they stay the same. Well, what they did is they're going to raid the cash inside of your policy as it was starting to grow. They're going to start to take cash out of that policy to pay the increase in premium. That way they don't have to bill you. And what's going to happen is when it eats up all the cash inside of that program, remember on my other video I'm talking about insurance expiring? Your policy will expire. And there's a ton of folks I know watching this video are probably wondering how their policy expired. Well, now you know. The cash was eaten up to pay additional premiums that the company told you your policy was not increasing. They just didn't ask you, they just didn't bill you for a higher amount. They just took it out of the cash. So I hope that's very clear in terms of the savings component. Well, I have a major issue with that, because if you told me as a bank, I'm putting money in my bank account, the first or second year I have no money, then when I finally start paying money, you're going to pay me 1 to 3%, then I got to borrow my own money. And I didn't even tell you about the fact that this is what's even more incredible. If you die, your family don't even get the savings. Now, think about that. You have a $100,000 life insurance policy. You got $50,000 saved. Your family's thinking, hey, $100,000 insurance, $50,000 savings, we get a $150,000 check. It don't work that way. They're going to give you, they're going to say, well, really, they're going to give you an option. They're going to say you can take the cash or you can take the face amount. Now, we know, anybody knows, you're going to take the bigger one, which is the face amount. You're going to get $100,000. So the question is, they paid for savings, they paid for insurance. Why is it they only get the insurance? Now, what the company will tell you is what has actually happened is $50,000 of that was actually the cash accumulation. So you are getting your cash. Okay, I don't care what kind of twist you put on it. That means you only paid me $50,000 insurance and I paid $50,000 of my own death claim. I don't care how you look at it, $50,000 is missing. That's why the concept is keep them separate. and then you don't have that issue. Okay. But not only that, they do have the programs that they put in place now that gives you the option to actually get the cash. I mean, think about that. I mean, the industry acts like they're amazed that you paid additional money to have a cash accumulation, and you actually wanted it. So they actually put in an option so you can get the cash. Isn't that amazing? But here's the problem. The cash will grow a lot slower in those programs because they have to actually give you some money if the death occurs, because they have to give you both. And the policy itself is going to cost you more money. So in other words, a real quick example. Let's say for term, it was $50 for that particular program. For the cash value program, maybe they're paying you, charging you $100, $150 a month for the exact same program. And then you say, but I actually want the savings. They go, oh, man, whew, we didn't know you want the savings too. Well, that was going to run you like $200 a month because, you know, I mean, we have to give you the money. Folks, think about that. When I went from paying $50 to pay $100 or $150 a month, I was paying to have a savings component. So I'm assuming I'm getting both. And they go, oh, no, that's not the way it works. But your family finds it out after something occurs. So anyway, I hope I was very clear on that. I hope you get it again. As I always say, it ain't right. It ain't wrong. It's just my opinion. But read your paperwork, and I know what conclusions you're going to come up with. This is Ron Certified Meyer signing off as your partner in success and in life. And I'll see you in the next video. Take care. Bye-bye.